Morgan Stanley and Bank of America, two firms that have been historically cautious on Tesla, both upgraded the stock from underperform to neutral this week. And joining us now is the analyst behind Bank of America's call, John Murphy. John, good afternoon.
Hey, John, thanks for having me.
Okay, so this has got to be tough. You were underperform on Tesla, and it has performed. But the upgrade to neutral, I mean, one could argue, I guess, that from here it's likely to underperform. But why do you just go to neutral?
Well, John, certainly I've been doing this for 22 years, and this is certainly one of the odder and tougher stock calls we've had. I think when you see a stock rocket like this, you kind of have to take a step back and ask what's going on fundamentally, at the company and the market's perception of it. And when you look at something like this is a growth story, and this is a growth story that's going to require a lot of capital. And the more capital that's available at a lower cost, the more this growth story can accelerate. And that's really what we're looking at right now. Is the potential for this company to leverage this stock price and really accelerate growth over the next 5 years. And that's really a key. It's somewhat of a self-fulfilling prophecy on the upside and the downside for this stock and the growth in the company.
It seems, though, John, like almost nobody is literally neutral on Tesla. Either you feel strongly one way or the other about it. Has your fundamental take on Tesla changed?
Well, I think you also have to look at what they've done recently. And execution, particularly in the second quarter, was pretty good. And was much better than expected. Then you look at what they're doing in Shanghai, Berlin, Austin, Texas. And the expansion of capacity is beginning and coming. Looks like it's going to be very real here in the near term. And their ability to execute on that and learn how to put that in place, is changing. Seems like it's more real. And you're going to need a lot of capital to do that in the future. And once again, coming back to the stock price to fund this, that is changing our fundamental view. I mean, if the stock went back to 500, they have a lot less, capital available to them, and it would be at a higher cost. And that would stunt growth going forward from a capital raise standpoint. So, there is execution and there is, capital available. And those are two things that are admittedly changing fundamentally here.
So you've talked a little bit about why you changed your mind. Talk us through the new price target, $1,750. How do you get at that kind of valuation when before you were at 800?
So, simply it's 8.5 times EV to sales, a bit of a premium to some of that, the high flyer FANG stock. So not an auto stock valuation, whatsoever. Sarah, I think as you look at this and, we run our scenario analysis and at the 1750, the company could potentially raise $36 billion in one, fell swoop here, 10%, of the current market cap, or maybe do that in sort of increments over the next 5 years. That would allow them, to accelerate growth from roughly 20% on units and earnings over the next 5 years to something in the 50% range, plus or minus. So that acceleration in growth starts to justify these much higher multiples, particularly also if you look at a DCF and a tripling of that ultimate free cash flow that we're forecasting in our base case scenario right now from $5 billion to maybe as much as $15 billion by 2025. You start looking at this and the current price or a little bit above that at $1,750 as we're estimating starts to look somewhat reasonable. Now, the company needs to execute once on these capital raises and two on these capacity expansions to really keep this story going and to keep us in the neutral camp.